Even though, but my problem is you've agreed the rent increase already for next year, so it doesn't all match up to me because you don't normally agree the rent increase when you both have a right to cancel up front. It's just I find it a bit unusual. But if you both have a genuine right to cancel, it's a short-term lease. But usually when you go through the details, the devil's in the details, usually it's only one party that can cancel. So that's a problem that I'm having. Like in the UAE, the contract that he described, I would treat it as a 2-year contract because in the UAE, the government won't let the landlord kick you out. And you sign it with a 1-year renewal. So I would treat that in the UAE as a 2-year lease.
But in UAE, renewal takes place every year in rent contracts.
Not all of them. Some of them are long-term contracts.
In residential?
Residential, I'm talking about commercial property. Residential, yeah, you renew it every year.
Mike, the auditors, before taking any decision whether it's a long-term lease or a short-term lease, will, I believe, take representation from the management whether they have the intention to continue this lease for a longer period of time. Because if the auditor is to decide whether it's a short-term lease or long-term lease based on the substance, then definitely it will take representation from the management that if the management intends to continue it for the longer period of time.
But the difference is, when we get to the lease term, I'll get there in a second. When you get to the lease term, it's not just the representation. There needs to be an economic incentive for renewal. So the reason why I'm going to renew is because I can keep the price the same and rents are going up. The reason why I'm going to renew is because I've done leasehold improvements. So management intention is not strong enough. So the renewal period in IFRS 16, the watermark is not just management intention. The watermark is a little bit higher. There's an economic incentive to renew, such as the leasehold improvements, such as the rent is fixed. And we know rents go up every year, but you have the option to renew at a cheaper rented market. If there is no economic incentive, then you do not take into account the renewal period. Because the argument is you can make a decision to move at that point in time. So no, it's not just the management representation. They'll ask for this as an auditor maybe, but it's a higher threshold than that. So the conclusion here, both parties have a genuine ability to cancel every year. And if it's gray, you're going to have to go into more detail. But usually in most companies that I've worked with, it's one-sided. That doesn't count. All right? Low-value assets. This we don't have in U.S. GAAP, it's specifically in IFRS. And what it's basically saying is the assets are individually low. Even though in aggregate they're high, we can leave them out. So individually low and aggregate high, we can leave them out. So like laptops, iPhones, those kind of things. Where in U.S. GAAP, if they're high as a group like laptops, we can't leave them out. So the thing here in IFRS makes it a bit easier. They're not independent, they're not interrelated. So based on your materiality, treat those like a regular old operating lease. Probably phones, laptops, things like that. No. Materiality is not defined in IFRS. It's defined in the audit literature.
Yep, and that's where we have some practical thing that some branches in remote areas carry low rent, and the underlying, so that implies that underlying asset is of low value. But then IFRS happens to say it has to be low value, not for the bank, but for all the people in the market or the country. So that's where it's like we are stuck. Now, can we take a call based on the materiality that generally IS deals with, that for a big bank, maybe 50 million is not a material amount, but then for some, like, I mean, as an individual, it is a material amount for me. So what's the take on that?
Well, I think the individually low, it is a concept that's entity specific on materiality. So I don't think it relates to the market. It's individual. So this is based on, this is entity specific.
Well, in IFRS, it discusses that it has to be of low value for all the players in the market.
In IFRS 16 it says that?
Yes. So say, for example, the cell phone is of low value for everybody in the
But I don't think it says to the market. Let me see if I can pull up the standard. I didn't bring a standard book. Let me see. I don't think it says that. You sure? Yeah. To the market it says.
Yeah. And then on top, to make things more difficult, PwC has issued a guidance that items of $5,000 or less are low value, otherwise they are not. So then again, we are kind of
PwC guidance.
For property, it's never $5,000.
It's written in basis of conclusion in a discussion paragraph that, for example, amount of $5,000 can be taken as low value.
That's PwC, but IFRS itself does say that the low value item has to be for everybody, not just the size of the entity adopting IFRS.
Basically, IFRS says that this threshold should be same for everyone.
No, but it cannot be the same because it depends on the entity size as well. Because one thing can be material for one entity but not for the other.
Basically, this is the point where regulators should intervene and set a threshold that for the economy of Pakistan, this amount should be considered as low value.
Again,
but
not for the economy. Again, it has to be entity specific.
No, it cannot be entity specific.
Let me look it up and come back to you. I didn't bring a standard book with me. So you have the standard book there. Okay, we'll look up on the next break. I'll come back to that. Because the spirit of this is, yeah, I understand your point about comparability there, but what they're trying to basically say here is it's things that generally are like the examples on the phone and the standards are like laptops, phones, small things. So the moment you say a lease for a branch, that to me doesn't sound that small. So low value assets are, I think, I will look at it again, but I didn't see I thought it was entity specific, but I don't think a lease that you're talking to, that would be too big.
Yeah, but then some leases that we have, they are
Really small.
For the bank, and we could say that, okay, this is the threshold, we could write up a policy for ourselves, but then we are not quite sure that.
Okay, let me come back to that one. I need to look that one up. I haven't had that question yet. It's a new standard, so the problem I have when you teach new things is always new questions pop up. That'll be on my next exam for my next students, right? So that's a good question there, and I will look it up on the next break. So obviously, what's changed is in the balance sheet now we have a new category of assets called right-of-use assets. So you either have to disclose those on the face of the balance sheet or in the notes. So right-of-use assets is a new category defined in IFRS 16 for assets that you don't own. You have a right to use. You don't have to separately disclose it on the face of the balance sheet, but you must disclose it in the notes. So buildings you own, right-of-use assets, they must be shown separately. They must be separately disclosed. The income statement, obviously, EBITDA is going to change, and it's going to change our amortization. We spoke about that already. So, again, as I said to you, your net assets will generally go down. So, in an example here, you have a 3-year lease, payment is $15,000. If you apply a discount rate of 8%, on day one, assets equal liability. But you're never at day one, right? You're never at day one on everything. So the asset usually goes down on a straight line basis, but the liability will go down based on the effective interest rate method. And what you normally find is assets minus liabilities are only going to be the same on day one and the end. But never do you have all your assets on day one at the end. You have a combination of assets. So what you're generally going to find is your net assets will go down. So for some companies, this has a big impact because you can't have negative assets. In some countries, it's against the law. You have to have, your net assets have to be positive. So this can have an impact on your net assets. It could have an impact on solvency in some places. So this can be an issue for some companies. The lease term as well is another thing to talk about. The lease term is based on the period that cannot be canceled plus the option renew periods. And we're looking about here is the certainty to extend them. So the emphasis tends to be on the economic incentive. If there is no economic incentive to extend, the way I like to look at it, is there a genuine decision point? If there's a genuine decision point that you may extend, you may not extend, then the lease is just the first term. But if that genuine decision point is not there because you spent so much money to renovate the office, then you would need to include the lease term to be the 10-year period. So the way it works, okay, who did Amazon just buy? What store? Do you know?
Souk in Dubai.
Whole Foods.
Whole Foods. Okay. Why did they buy Whole Foods?
They were in competition with Amazon.
Not really. It's a supermarket.
They wanted to diversify into organic or.
They're pretty smart. They're like the Chinese. He's very smart, right? They want to take over the world, right? He probably bought Whole Foods because they have it's a good distribution point. And the perspective is, when you go into the supermarket, there's some things you want to buy now that are fresh, right? Women like to feel the lettuce. Oh, does it feel soft and smooth, right? They don't feel the can of tomatoes. They feel the tomato. So there's a perception that maybe people would be willing to buy some stuff which comes straight to your house, and other things you would buy in the market because you want to touch them. You want to see the meat. Is it red? Is it the right flavor? Is it the right cut? So I think what Amazon is trying to do is change the shopping experience. So when you go into the supermarket, some stuff goes straight to your house. The cans, the toothpaste, the toilet paper, you don't need to see it, right? It just comes straight to your house. The other stuff, you want to see it. Now, how does this affect leases? Carrefour currently has these huge stores, right? You go down the aisle and you have 85 toothpastes to choose from, right? And you have to pick one of them. And then you pick one and use that one for the rest of your life if you're a guy because you want to keep changing your mind, right? So the idea is that Amazon probably is going to change Carrefour because eventually what's probably going to happen is you're going to go into the supermarket and that stuff gets shipped to your house. So, in the perspective of Carrefour, they have a store in a shopping center that's huge. The rent's expensive. They have a 20-year lease with the option to renew for 20 years. So is the lease term 20 years or 40 years from IFRS 16's perspective? They have a lease for 5 years with renewal for another 5 years. Is it 5 or 10 years? Probably 10, right? That one's easier. The longer out you go, the economic benefit, the uncertainty becomes higher, right? I mean, 10 years ago, I'm not sure how it works here in Pakistan, but 10 years ago, my mom's 80 now, she didn't buy anything on Amazon. 10 years ago, my mom would get in the car and drive to the store, no matter what it was. Now, my mom, who's 80, will get on the internet and she'll buy everything from Amazon. Now, 40 years from now, or 20 years from now, what's going to change? I don't know. So I would argue that when you have long leases, like 20-year leases, in a retail outlet with a 20-year option, it's very difficult to argue that the 20 years from now, the economic incentive is there, the decision's been made. Because there's so many things that are going to happen, right? mean, if I go back 40 years ago, I remember when email came out. Remember when email came out? Probably most of you are too young here. But when email came out, I remember in 1990, I was in my office, and email came out in 1992. I go, this is really stupid, because we were at Deloitte's. We could send email from to our other people in the team. I go, well, this is dumb. I see them in the office. I'll just give them the disk. And then eventually email came out where we could send it outside on the internet. So when email came out to what it can do now, it's changed everything, right? Now you go out to dinner with these young people and they have their phones in front of them all the whole meal, right? And they're taking pictures of their food and sending it on Facebook saying, isn't this a nice meal? It's like, well, why don't you put your stupid phone down and talk? So my point is, I think what we're going to find is the food industry can change. So when you look about the economic incentive to renew, I would argue this, an example like Carrefour, it's very difficult to say 20 years from now Carrefour is going to stay there. Even banking industry has changed. It's become, you know, in the old days, you would go into the bank, do everything, right?
Smart machines
Now, I mean, on my phone, I'm not sure if you have this in Pakistan, I can take a picture of a check. I keep the check at home. The check goes deposited in my account. I don't even give the check to the bank anymore.
Smart machines also, you can scan the check on the smart machine.
But I'm talking about retail customers, me.
Yes.
You give me a personal check, I just take a picture of it.
We do have to check deposit machines as well. Yeah.
But not for banks, just for normal people. Yeah. So even the banking sector, do we need these big branches? Probably not. Who knows? So the moment there are uncertainties, the lease term is probably more questionable. So my view is when you have a long lease with a long renewal, it's hard to say the second renewal option, I would include that up front. Because things are changing so much. Now you have like a McDonald's or a KFC, a lot of those have 20-year leases with 20-year renewals. That's the standard in the U.S. I mean, there's a stronger incentive there to renew because, but it's very difficult to predict, right? So this becomes messy. So my view, and I haven't really seen a precedent set by the Big Four yet, but my view is when it's really long, how can it be probable? Is my view. And usually, you know, the auditors are obviously going to be more conservative and say, hold on, yes. So when I was at Carrefour, I said, you can't say you have a 20-year lease with a 20-year renewal because things can change so much.
But if it is too uncertain, then why it was included in the agreement?
Well, because it's an option you want to have. I mean, if you're a tenant, you always want that option there. You built up a business, you don't want the landlord to kick you out.
Even after 20 years.
Correct.
But if you right now, if you have an option after 20 years, that tenant has a right not to terminate the contract, but that right can be exercised after 20 years.
Correct.
Right? That's a privilege that tenants have.
Correct.
Right?
It's one-sided.
One-sided, but to relocate the store from one place to another place it's very big.
But my argument is, I get that, but 50 years ago, supermarkets didn't change.